The Property Bulletin by London Property, the home of superprime.
In a notable move in London's thriving real estate scene, Igor Bukhman, co-founder of gaming powerhouse Playrix, has recently added another jewel to his property portfolio, a Kensington mansion worth a staggering £24 million. This acquisition follows his purchase of a neighbouring mansion in 2019, which set him back over £45 million. Hailing from a city near Moscow, Bukhman, with a net worth of approximately $3.5 billion, has strategically invested in these adjacent properties as part of a comprehensive plan for their renovation. The move underscores the billionaire's commitment to the London luxury real estate market, which has displayed resilience amid global economic fluctuations and increased interest rates by central banks. London's allure for high-net-worth individuals remains evident, with affluent overseas buyers spending over £100 million on properties in the city in 2023. Kensington, in particular, accounted for 11% of all transactions exceeding £5 million, according to data from broker Savills. Other notable buyers in the market include Selina Chow, co-founder of Hong Kong billionaire Li Ka-shing's venture arm, and Citadel trader Adam Frame. Despite a reported 33% decline in sales in London's most prosperous postcodes in November compared to the same period the previous year, a report by Beecham Estates indicates that today's billionaires, primarily from finance and tech sectors, typically allocate about a third of their wealth to residential real estate. Moreover, the number of super-rich individuals is expected to grow by 28% by 2026, reinforcing the long-term optimism in the market. The Bukhman brothers, not content with their success in Playrix, have expanded their investments through Rix Capital, their personal investment firm. The move reflects a broader trend among billionaires, many of whom allocate significant portions of their wealth to real estate. Despite Playrix's headquarters relocating to Ireland a decade ago, the brothers continue to make strategic property investments in London, showcasing the city's enduring appeal in the global real estate landscape. Foreign home buyers took over more of London's luxury housing market last year, while domestic demand dwindled. International buyers purchased 45% of homes sold in central London's most affluent postcodes in 2023, up from 39% in the year prior, according to Hampton's international data seen by Bloomberg. The change was driven by a larger share of buyers from Asia and the European Union, with the former making up almost a third of overseas home purchases in both prime central areas and Greater London, the highest level in 5 years. International-based buyers purchasing an investment property or second home in London were probably less exposed to the mortgage rate volatility witnessed in the UK, said Anisha Beveridge, head of research at Hamptons. Many of these buyers purchased properties with cash, while others looked to borrow money in their home country. Still, given the reduction in overall transactions last year, the absolute number of homes bought by international buyers was likely down on an annual basis, Hamptons said. Rising borrowing costs, economic uncertainty, and the worst cost of living crisis in a generation have driven a slowdown in overall UK house sales. Demand is still being affected in advance of a general election that's likely to take place this year. At the top end of the market, domestic buyers' reluctance was shared with Middle Eastern and American purchasers, who had flocked to London in 2022 to capitalise on a weak pound, but are now feeling the pain of an appreciating currency. US buyers dropped to 2% of all purchases from 7% a year earlier. It was the surge in buyers from Asia, driven by easing COVID-related travel restrictions and a more generous visa program for Hong Kong residents, that boosted the share of overseas deals in London. By contrast, the market in Hong Kong, under pressure from political uncertainty, is likely to see an increase in distressed sales this year, as vendors look elsewhere, according to a report released this week by broker Savills. Selina Chow, the co-founder of Hong Kong billionaire Li Ka-shing's venture arm, bought a luxury flat next to Green Park for £20.5 million in August last year, one of the capital's biggest apartment deals of 2023. Xu Xiaoping, one of China's most successful angel investors, bought a £38.6 million property nestled between Green Park and Berkeley Square a few months earlier. EU buyers also indulged in the city's real estate, with the block's share of prime central London purchases rising to 18% from 12% in the previous year, marking a recovery to pre-Brexit levels. Nina Floor, daughter of Swiss businessman Thomas Floor, bought a terraced house in the affluent Knightsbridge neighbourhood for over £30 million in February last year. It's likely that 2023 marks the new normal for the share of homes bought by international buyers, Hamptons Beveridge said. Deeper economic and political uncertainty in parts of Asia and the Middle East, combined with a brighter outlook for London's property market, might tempt more investors from these parts of the world. Still, a wave of elections due to take place in almost 70 countries in 2024 may restrict prime residential home values in major cities, according to Savills, which could point to reduced demand from international buyers. The biggest concerns for the rich looking to buy UK property include stamp duty, higher scrutiny into finances, and the potential for a Labour Party government at the next election, according to research published in November by Beecham Estates. However, Joe Eccles, managing director at London Buying Energy Ecord, said Shadow Chancellor of the Exchequer Rachel Reeves's commitment to rule out a mansion tax last year should ease concerns. This time round, the main political parties are more centrally aligned, Eccles said. Whatever the outcome, buyers aren't expecting any major property-related policy changes in either direction. Wealthy tenants are demanding prime rental units with the highest specifications, according to lettings agency Knight Frank. The agency advises landlords to fit out homes in prime locations to the same high standard as properties being sold. Knight Frank notes that global ultra-high net worth individuals prefer the non-permanence of renting, with super prime lettings often competing directly with luxury hotels in London. This trend could intensify if there are changes to the non-dom tax regime or an increase in the surcharge for overseas buyers after the next general election. Landlords who follow this advice may achieve higher investment yields, given the rarity factor at the top of the market. In recent years, the high-value London property market has seen relatively uneventful performance, with average prices growing only 0.7%, reflecting the impact of successive lockdowns and international travel restrictions. However, this has led to an increase in super prime tenancies, with more owners choosing to rent out their properties rather than sell. The number of new listings above £1,000 per week in London increased by 30% in 2023 compared to the previous year, according to Knight Frank data. Below £1,000 per week, there was an equivalent rise of just 0.5%. Cracks in the commercial property market are expanding, extending from offices to apartment complexes, raising concerns of distress in the housing sector. Over $67 billion worth of housing is potentially distressed, as borrowers grapple with repaying loans extended during the peak of the pandemic. This trend poses challenges for lenders like Arbor Realty Trust Inc., which concentrates on packaging floating-rate loans into commercial real estate, CLOs. Preliminary data indicates a significant increase in the share of loans in Arbor's CLOs that failed to make scheduled payments in Q4, potentially impacting the wider CLO market. Apartment building financiers, often relying on floating interest rate bridge loans, are particularly vulnerable amid a sharp tightening in monetary policy. Lenders like Arbor face risks as they provide the equity portion of CLOs, the riskiest part, while selling safer tranches. Rising interest rates, contributing to lower property values, are leading to concerns about potential distress in the commercial real estate market. The multifamily delinquency rate for commercial mortgage-backed securities is expected to double this year, reaching 1.3%, according to Fitch Ratings. There is growing speculation about potential stamp duty reforms in the upcoming spring budget, fueled by government data showing a 21% drop in stamp duty land tax (SDLT) receipts for Q4 2023, compared to the same quarter in 2022. This decline aligns with a 20% fall in transaction numbers, indicating a cooling property market. SDLT has been a robust revenue source for the government, with receipts estimated at $15.4 billion for the 2022-23 tax year, a 9.2% rise from the previous year. Despite its growth, SDLT is becoming ever more unpopular with home buyers, leading to calls for urgent reforms. The Institute for Fiscal Studies chief, Paul Johnson, suggests changes to SDLT could stimulate the housing market and contribute to economic recovery. With the spring budget scheduled for March 6, there is anticipation that Chancellor Jeremy Hunt may introduce SDLT relief measures, possibly including adjustments to thresholds, rate reductions, or another temporary holiday. Given potential constraints on public finances, targeted cuts to levies like SDLT or inheritance tax may be more feasible than broader tax reductions. High SDLT bills are seen to impact housing market mobility and discourage downsizing among older homeowners, contributing to the shortage of family homes. This issue could become a significant policy topic in the lead-up to the general election. The UK's hunting estates are experiencing a shift in buyer demographics, with a new wave of affluent individuals showing interest in these properties for environmental conservation purposes. Rather than focusing solely on traditional sporting activities, these buyers are seeking opportunities to restore and preserve natural ecosystems. Initiatives such as afforestation, peatland restoration, rewilding, and regenerative farming are at the forefront, aiming to revitalize the land and contribute to climate change mitigation by capturing and storing carbon dioxide. Jess Simpson, a buying agent specializing in rural estates, notes that some buyers pursue these acquisitions for altruistic reasons, investing in nature preservation, while others also consider the potential for long-term financial gains in natural capital assets. These high-net-worth individuals often target super high-end country estates priced between £10 and £20 million. Sporting estates are increasingly being sold to investment funds and private individuals, with a notable surge in sales for natural capital reasons. For instance, Oxygen Conservation, a UK-based company, purchased the Mornicott estate in Devon last year as part of its commitment to restoring land on a significant scale. Their portfolio now spans 10 rural estates, covering 30,000 acres, with plans to expand to 250,000 acres by 2030. Noteworthy examples include the Durrell Wildlife Conservation Trust, securing a lease on the Dulnacardock estate in the Scottish Cairngorms National Park for a 100-year rewilding project. In the real estate market, properties like the Rothbury estate in Northumberland are promoted for their environmental enhancement opportunities, incorporating features such as sporting farming, tree planting, and carbon offsetting. Financial incentives, including sustainability-linked government subsidies, the UK's Biodiversity Net Gain Initiative, and carbon offsetting schemes, play a pivotal role in supporting these conservation endeavours. The emerging carbon market, particularly the demand for voluntary carbon emissions credits, is projected to reach between $10 and $40 billion. While not every rural estate presents natural capital opportunities, Scotland has become a hotspot for sustainability projects due to its vast woodland, moorland and peatland offerings. In contrast, England faces challenges as land is more expensive and less available in large acreage. Nevertheless, certain English counties, like Northumberland, provide opportunities for conservation-oriented land purchases. The evolving landscape of nature-based carbon offsets and biodiversity initiatives reflects a growing commitment among affluent buyers to contribute to climate change mitigation and ecosystem restoration through strategic investments in the UK's hunting estates.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.